Welcome to another episode of Unlocking the Upside. I'm your host, Jeff Robinson, and today we're diving deep into one of the most critical issues facing investors, market concentration, with the Magnificent Seven dominating returns and concentration levels approaching historical highs. Understanding this phenomenon is crucial for any serious investor. James, I've been looking at some fascinating data on this.
Hold on there, Jeff. Before you get too deep into the numbers, let's help our listeners understand what we mean by market concentration and why it matters.
The stock market has undergone a transformation that would shock investors. From just a few decades ago, today just 10 companies control more than a quarter of the entire market's value. That's a level of concentration we haven't seen since the era of industrial giants in the 1960s.
That comparison to the 1960s is fascinating. But what makes today's concentration so different from what we saw back then?
Well, it's all about the fundamental drivers. Back in the 60s, market leaders were industrial powerhouses that required massive physical infrastructure. Today's giants like Microsoft and Apple dominate through digital platforms and network effects that actually become more valuable as they get bigger.
So if we look at the numbers, these companies aren't just big, they're incredibly profitable too.
That's exactly right. Here's what's mind-blowing. Between 2014 and 2023, the top 10 stocks generated 47% of total economic profit while only representing 19% of market cap. By 2023, it got even more extreme. They were producing 69% of economic profit with 27% of market cap.
Those profit numbers really show this isn't just market hype. These companies have built incredibly efficient businesses.
And you know what's fascinating about the historical perspective? Since 1950, only 17 companies have managed to crack the top 3 spots by market cap, and just 11 stuck around for more than 2 years. It really shows how tough it is to maintain that market leadership.
The turnover at the top tells quite a story about American business evolution, doesn't it? From General Motors to AT&T to today's tech giants.
Speaking of evolution, let's talk about why these modern giants are so different. They benefit from what economists call network effects. The more people use their platforms, the more valuable they become. Think about how something like Microsoft's Office Suite becomes more valuable as more people adopt it.
Well, that's quite different from traditional businesses, where growth often meant diminishing returns.
Exactly. And here's another key difference. The barriers to entry these companies have created are almost impossible to overcome. It's not just about having enough capital anymore. It's about massive data sets, complex algorithms, and network effects that can't simply be replicated.
You can see it in the numbers too. The gap between return on invested capital for large versus small companies keeps getting wider.
This creates some fascinating challenges for investment professionals. Most active managers have historically built portfolios with lower average market caps than their benchmarks. That strategy worked well in the past, but in today's concentrated market, it's becoming a major handicap.
The performance data really drives that point home, doesn't it? Only about 30% of US mutual funds beat their benchmarks during periods of rising concentration.
And here's something counterintuitive. Investing in whatever company happened to be the single largest stock by market cap has historically been a poor strategy. But investing in the second and third largest stocks, that's actually produced better returns than the market average.
That's such an interesting finding. It suggests there might be some sweet spot in terms of market leadership.
Looking ahead, we've got some major technological shifts that could actually intensify this concentration. Artificial intelligence, for instance, tends to benefit larger companies disproportionately because they have more data and resources to leverage the technology effectively.
Though we should consider the potential counterforces at work, like increasing regulatory scrutiny and antitrust concerns.
That's a crucial point about regulation. The modern antitrust framework focuses more on consumer welfare than pure market concentration, which makes it harder to make a case against companies that provide free or low-cost services to consumers.
So what does all this mean for investment professionals trying to navigate this environment?
Well, they need to fundamentally rethink their approach to portfolio construction. The traditional rules about diversification might need significant updating when just a handful of stocks can have such an outsized impact on returns.
And the global perspective makes this even more complex, with US companies now making up about 60% of global market capitalization.
You know what's particularly interesting? The role of passive investing in all this. As more money flows into index funds, it naturally reinforces the weight of the largest companies, potentially creating a self-reinforcing cycle.
That's a crucial point about market structure. The rise of passive investing has fundamentally changed how capital flows through the markets.
Looking at all these factors together, it really drives home how different today's market environment is from anything we've seen before. While we might have similar levels of concentration to what we saw in the 1960s, the underlying dynamics are completely different.
So what's the key takeaway for investors trying to navigate this new landscape?
Success in this environment requires a much more nuanced understanding of concentration dynamics. It's not enough to just look at market cap weightings. You need to understand the fundamental drivers of concentration, the sustainability of competitive advantages, and the potential risks and opportunities they create.
That really brings us full circle to why this topic is so important for anyone involved in investment management today.
Indeed, it does. The market concentration we're seeing today isn't just a statistical curiosity. It's a fundamental feature of modern markets that requires new approaches to portfolio management and investment strategy. Looking to elevate your market understanding to institutional grade, I'm Jeff Robinson, and throughout my career analyzing markets, I've seen how crucial it is to understand concepts like market concentration and its impact on portfolio returns. That's why I created Insight One. It's where deep market analysis meets cutting-edge learning technology. Whether you're managing billions or just starting your investment journey, Insight One adapts to your level, helping you master complex market concepts through interactive, personalized learning experiences. Ready to think like a professional investor? Join us at theinvestmentanalyst.com or find Insight One on your favorite app store.